right, good. Access to this webinar is for educational and informational purposes only. Consult a licensed broker or registered investment advisor before placing any trades. All securities and orders discussed are tracked and monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither PhilStockWorld.com, PSW, nor its affiliates, nor any of their respective officers, personnel, representatives, agents, or independent contractors are in such capacities licensed financial advisors, registered investment advisors, or registered broker-dealers. Nothing contained in this webinar website or promotional material constitutes promotion, recommendation, solicitation, or offer of any particular investment, security, or transaction. Trading options involves risk. Visit the OCC website, www.optionsclearing.com, to read characteristics and risks of standardized options. PSW provides education and training services that are meant to teach you the risks and potential rewards of trading options, and we are not a service that tells you what to trade. We are not implying or guaranteeing any profit. As always, do not trade with money that you cannot afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and are only valid on that specific or identified date. Your results may vary. By accessing this webinar, you agree to hold the above harmless from any losses you may incur as a result of the information discussed in the media identified above. By accessing this webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured we take your privacy very seriously, and we will not distribute or sell your information to anyone. Fantastic. Now we can get going. Just tell you what, let's just take a quick look at the markets and see where things are looking. Check the futures. All right, so on the whole, we're way off these lows that we had at 10. Because once again, it's been Europe dragging us down. See how like Europe closes at 11:30? All right, so that's basically, that's 11, it's about 11:30. So here's Europe closing, lots of selling into the close of Europe. And then we seem to make a nice recovery. Here's the Russell coming back. Here's 11:30 over here, 11:30 over here. So it seems to be like Europe is just not happy. Although, honestly, look at the DAX. So the DAX wasn't that bad. You know, it wasn't particularly Europe, but they seem to be selling our stocks for whatever reason. Because we're getting sort of an easing of pressure at that time, same as we did yesterday. Oil's up a little bit. Notice how WTIC is up 1.23%, Brent's only up at 6.06%. Gasoline's down. We were talking about that, how what they call the crack spread. The crack spread is the difference between the price of gasoline and the price of the barrel of oil when you crack open the barrel of oil to make the gasoline. That's what the crack spread is. And we talked about how Valero, which is in our butterfly portfolio, is very high, but it's very high because they're enjoying a much wider than usual crack spread, and we expected that to deteriorate. So deteriorating crack spread means that the price of oil is climbing while the price of gasoline is flat or declining, and that's going to make the spread that the money that the refiners are going to make is less when that happens. So we're seeing that. Natural gas has been very nicely holding up today for a change, not so. You know, most days it kind of comes up and goes back down. It's finally like holding a little bit. Hope that continues. Gold is recovering slightly, but very slightly. Silver also. We want to go long on silver, but only over the 1450 line, not under it, over the 1450 line, or at 1425 with a very tight stop, or at 14. So in other words, we'll take any 25-cent line and go long up to 1450. I forgot to turn off the mics of you guys. Hang on a second. I always do that.
You are now muted.
There. Now you can make noise. Because we can't hear you. Where was I? Futures. Right. Copper, no demand. Platinum. Palladium, platinum. You know, no real demand in metals at all. It's just, look, cattle, no demand. Other cattle, hogs, no demand. Corn, no demand. Soybean, no demand. People don't have money. This is what happens when the bottom 90% people don't have money to spend. They don't eat. They don't eat to excess. They don't eat a lot. See, okay. Not as true in other countries, but very true in America. When we eat out, we eat like double portions of everything. So whenever Americans have money, we eat out more, and when we eat out more, we consume unbelievable amounts of food. But when people are not eating out a lot, they consume a bit, the food consumption does drop off pretty considerably. Even though you say, oh, well, people got to eat, they don't have to eat the way we eat. We waste, restaurants in America waste probably about 30-40% of the food that they prepare. But, by the way, that's a secret of a good restaurant. A good restaurant will throw away half the food they buy before they even cook it. Because they just only want the best peas and the best piece of broccoli and the best lettuce and so on and so forth. And they'll chop it up and cut pieces off, and all you get is the good parts. They throw the rest away. It's an incredibly wasteful process. That's good restaurants, of course. Bad restaurants like Chipotle they just kill people. Now, I'm sure it was an accident. So, whatever happened to Chipotle, they seem to be getting themselves together. Anyway, so there's a huge amount of waste in the restaurant industry. So the more people eat out, especially in the States, also in Europe, though, the more waste of food there is. And so even though you say, oh, it's just what's the difference if you have a meal at home or you have a meal out, the meal out uses probably almost double the food to get the same meal. So if 10% more people eat out, you're actually increasing the amount of usage of food by 10%. Sugar's been flying. Sugar is something I flagged much earlier in the year that we thought it was way too low, and it's really taken off now. Lumber's coming back a little bit. That's good. Coffee, yeah, see now coffee's interesting. There's going to be a certain parts of El Nino is going to kill some of the coffee production, so that could get interesting later. Go to a longer term view actually, so you can really look at some of these things they view. And now you can see, this is now days. Look at this. Look at the cattle, hogs, corn. This is consumers cutting back. When you see this trend across the board, this isn't weather. This is consumers cutting back. This is weather. See, when cocoa is in short supply, weather. Orange juice is a weather thing. Okay, it's the spikes of the weather for a couple of crops, not the general trend. The general trend is less. All the way across the board. Less metals, less commodities, less use of almost everything. That's not good. And meanwhile, look how horrible gold looks over the long term. It's hopefully finding a bottom here. Just as silver, hopefully. See how it bottomed out in September? We made a fortune off of that. So that's what we're trying to do that now, but you don't want to get too over anxious because you could hit 14. So you don't want to jump in and try to take a stand here. This is a very expensive contract to be wrong on. Gold, we don't mind because gold can only fall to 1080. And that's not percentage-wise a very big move, but 14 from 1436 is a pretty painful 2%. We're not too thrilled to get stuck in that if we can avoid it. The Nikkei is still way up there. Okay, that's going to be a fun short, but we want to wait and see what happens. Strong dollar is good for the Nikkei, so they're not going to come down unless the dollar calms down a little bit. And the dollar is, there it is, look at that dollar. That's a strong dollar. Strong dollar and strong Nikkei. See? In fact, last time the dollar was really strong, you can see right here. Last time the dollar was strong was back in September, these peaks over here. So you have right on top of the September, right on top of the October, and let's see if the Nikkei matches it. So right on top of the October, you see that spike up, and right on top of September, you see that spike up. That's what a strong dollar always does for the Nikkei. It helps lift it quite a good amount. Okay, let's see if we have any questions before we get going. I know there's one early on. Wayne says, would selling 218 UNG puts be a long-term idea? Would you consider the shorter April trade? I would consider either. I think natural gas is kind of silly low, and it's probably, it could. Well, no, I don't think, I think actually this will be the last time we ever get a chance to buy natural gas as cheap. Generally, I think I talked about this, didn't I talk about this already? Maybe, maybe not, all right. It's an important point. Historically, well, let's go to the futures chart on NG. Historically, natural gas, if I can find it, gasoline, heating oil, natural gas. Months. Okay. All natural gas has historically been a local thing. In other words, we don't ship it around. We don't send our natural gas to Saudi Arabia. They don't send their natural gas to us. Nobody moves natural gas around except for by pipeline. It just has been inefficient. There's been a massive change. Natural gas is a fairly clean burning fuel that's in fairly good supply. It's also pretty cheap to use, and it would be preferred if it were easier to get, but it's not always easy to get, and the supply tends to be interrupted because if there's like a hurricane or something that knocks out the supply, because you've been limited to the amount of gas that's sitting in pipelines and stuff, you don't have really storage of it. It's hard to store. It's just like gas. It takes up a lot of room. Now that they've perfected liquefied natural gas, and you've heard about this, of course, liquefied natural gas compresses the gas 600 times, 600 to 1 compression. So it makes it now efficient and cost-effective to move it around and sell it, including moving it to other countries. This is huge. It means basically that one liquefied natural gas truck can carry across the country as much gas as a pipeline could deliver in like a week. It's gigantic amounts of natural gas. In the United States, we have a $4 trillion BTUs of storage. That's a lot. Well, I'm sorry, I'm not 4 trillion. 4 trillion unit storage. We have 4,000 BTUs, which is 4 trillion units of gas stored on thermal units of gas. That's our total storage capacity, basically. We're near the top of that right now. And we're always near the top of that at the end of the summer because that's when we use the least. Getting into the winter, we start using it all again. And that's the thing. By the end of the winter, we drain it out. And then we have to replenish it over the summer. So, because there's a limited amount of storage, they have to not overproduce gas. Because they had too many gas wells, they'd have to shut the wells down half the year because you just wouldn't be able to fit any more gas in the pipeline. A few years ago, this actually happened in Europe. They actually put more gas into the pipelines than they had capacity for, and it was damaging the pipes. And what they had to do was they paid commercial users of natural gas to pull the gas and put it into their own storage facilities so that it would alleviate the pressure on their pipelines. That's how overstocked their pipelines were in Europe. They actually did pay their customers briefly to take the natural gas out of the pipeline. We get close to that here in the States, but we haven't actually had it happen yet. That would be negative prices on natural gas. Anyway, all that's going to change drastically because they're building these storage facilities. And these liquefied natural gas storage facilities are going to store a tremendous amount of gas. Also, we're going to ship our excess gas overseas. Okay? And we're doing it very slowly at first, and that's being done very intelligently according to the rules of the Energy Commission, because you don't want to. We don't know how quickly this is going to drain out our natural gas. You have to hope that as we ship more and more gas out of the country, that other suppliers will come online and find it profitable. But the code name for all that, when you say other suppliers will come online, it'll become profitable, is prices are going to go up. And we'll find an equilibrium at a higher price for natural gas, because our natural gas is probably about half of what Europe charges now for natural gas. And but that's because we can't ship our gas to Europe. If you could, then we'd find a point somewhere in the middle. So somewhere between our prices of natural gas and Europe's prices of natural gas, and Asia even, we can send our gas the other way to Asia, there'll be a point, probably somewhere around $4 to $6 is going to be the normal price for natural gas down the road. Now, it's not going to happen right away, but these terminals are going to come online. So now if I go back to, let's take a look at yesterday's post. I think I mentioned it. Oh, no, it was this morning's post. All right, hang on. I mentioned in this morning's post, AMI, here we go. These are notes from Kinder Morgan's conference call. Kinder Morgan has natural gas pipelines. And they're talking about how they're very bullish on the future. They expect an increase of demand of 5% for this year. That's this year, and increasing 40% by 2025. That's what they're seeing. Here's what we're currently doing. We have LNG export. That's the big change. Plus 7.9 BCF. This is all brand new. So currently, what we do with gas is we do industrial 3.5, power 5.7, and exports to Mexico 1.7. So that's 5, 8, 9, 10, 11. So there's 11 billion cubic feet per day currently. How much are we going to export? 8 million cubic feet per day. Billion cubic feet per day. That's not a little. This is 11 currently, and we're going to export 8 more, at least. That's almost double. So obviously that's going to have to come from somewhere. This is the main reason we're like super bullish on natural gas, because it's happening. We are going to be sending out. We're like the Saudi Arabia of natural gas. We have tons of it, and we're going to be selling it to the rest of the world. And overall, now, I've always been warning people about LNG because I'm not super gung-ho bullish, because the net effect, because we're not the only country doing it. Every country that's capable of making a lot of natural gas is building these LNG terminals, and everybody has the same business plan that they're going to sell LNG to everybody else. All it's going to do is flood the world with natural gas, and it's going to eventually find an equilibrium at a cheaper price. But that's over the next 3, 4, 5 years. Over the next 2 years, it is definitely going to start making natural gas more expensive in the countries that currently produce it, because we've never exported before. You know, so let's say the global average is currently $6, and we're paying $2 because we're a huge creator of natural gas. Maybe eventually everybody in the world will pay $4. So the rest of the world will come down, but we're still going to come up because it's going to be the global average price will be a certain thing. But people who think the global average price is going to be 8 and things like that, who are investing in these natural gas terminals, are going to get killed, because it's not going to happen. All it's going to happen is more and more capacity will come online, and all of a sudden, by the way, there's an illusion, because every time you build one of these terminals and start filling up ships with natural gas, you're taking a huge amount of natural gas out of circulation. When the real blowback is going to come, because it'll look like there's a lot of demand, but mostly you're just filling up ships with natural gas. The blowback will come when we filled up all the ships and filled up all the terminals, and then there'll be a huge backlash in price. But between now and then, we could see a very, very large increase in price. So my tune will be the exact opposite at some point. Natural gas goes up to like $12 again. I'll be like, no, natural gas is way too expensive, and here's why. Although then it might take years to come back down also. So we'll see what happens, but hopefully it won't burst up and burst down so quickly. So, coal is coming offline. All right, so thing number 1, coal's coming offline. You have to reduce coal consumption and increase natural gas consumption in order to do anything about climate change. So that's number 1, boom. Kinder Morgan's talking about Mexico, how they're going to sell more to Mexico. And the chemical industry is expanding, and more natural gas is being used in the chemical industry. But the biggest thing, as far as Kinder says, is LNG is coming. And so they're talking about LNG exports. They're talking about the number we looked at above is 8 million a day, or he's talking about 10.6 a day. But the bottom line is the first one, by the end of this year, and he doesn't mean this year, 2016, he means that by the end of this year, which is in 30 days, Sabine Pass will be in service and pulling 650 million things a day. So it's basically 1 billion cubic feet a day, or 2/3 of a billion cubic feet a day, will be pulled out this year in a month. Now, then the next terminals come on next year and will be up to about 2 billion cubic feet a day by the end of next year. That's 60 billion cubic feet a month. That's 720 billion cubic feet a year will be pulled out of our natural gas reserves. That's a lot. Okay, so and then by 219, so in other words, it's going to start there. That's just our first attempt. If 720 pulled out in the first year of our storage. Remember, our storage capacity is 8 trillion, so that's 20% of our natural gas storage is going to be pulled out. But that is their online capacity at the LNG terminal. That doesn't count the fact they're going to be compressing gas for storage. In addition to exporting it, they're also going to be pulling, so in other words, they're going to be exporting that much per day, but they're also going to be filling their underground storage. So the draw on natural gas will even be higher than 20%. So imagine, just saying that next year there'll be a 20% increase in demand for natural gas. That's gigantic. So that's already happening now. That's in the works. Other terminals will come online besides the ones he's talking about, but that's just to start. And overall, pretty much every year this is going to keep going. So natural gas, so that's the short answer to the question is that's why natural gas is a great, UNG is a great thing to own into the long term. Because it will go up, there's going to be a lot of pressure, and in the next 2-3 years is when it's really going to be kicking up specifically. So this is the perfect time to buy UNG. And frankly, I think natural gas is being pushed down by the people who, they're manipulating the price low because they're trying to buy all these long-term contracts, the LNG providers, the LNG exporters, because they want to lock in long-term contracts at low prices. Then they're going to be thrilled to let the price fly higher. So there's a lot of cross currents going on in natural gas. But many, many reasons that it's a really good buy right now. And the number one, though, is the LNG exports put sort of a floor into the whole thing. Oh, so looking at looking at the specific thing in UNG, if we go down to, how far, we can go to 2018. Now remember, all these kind of ETFs, they tend to decay over time. So you're going to expect to lose a bit of position on a flat. If the thing stays flat, your ETF will erode a little bit also. But again, don't be a sucker, because you can buy, let's say, see these $7 calls for $4. The last sale was $4 on the $7 calls, and you can sell the $12 calls for not 174. Now notice here, I'm going by the last sale because the last sale is between the bid and the ask, so that makes sense. Here, when I look at the 12, the last sale was 174, but the bid is 185 and the ask is 212. So here, I would certainly expect to get 195 to $2. So the net here, I would look for the 7, buy the 7, sell the 12. So for that spread, you should be able to get that spread for about $2. Okay, and if you and the way you would do it is you make the offer and you say, I would like to pay $4 for this one, I want to pay $2, and I want to sell these for $2, and you hopefully will get a fill. You're going to get a fill on one end or the other. That's why you should always offer a low amount on each leg of the spread you're working into, because you're going to fill one side or the other if it moves up and down. You're not going to not fill both. It's going to fill. So eventually you'll start getting your position worked in. If it zigzags up and down the way natural gas does, you should do very well. So there you're buying a $5 spread for $2. There's really no need to do anything else. I mean, that pays off. You make 150% profit in 18 months, not in 18 months, I'm sorry, in 24 months. You make 150% profit. Okay, there's nothing wrong with that. Now, you talked about selling puts. Yeah, you can also sell some puts. So if you want to sell these puts, the $8 puts for $1.50, I think those should hold up nicely. And then if you sell those for $1.50 and you buy this thing for $2, now you pay 50 cents net for a $5 spread. And all UNG has to do is be at $12 in 2018, and you're going to make $4.50 against your 50-cent cash outlay. So that I love. That's a great spread. And we may end up turning the UNG position we have now into a spread like that because it pays off just so much. The return on cash is fantastic on that. And the margin's not bad, because if you look at B8s, if you sell these guys, if we sell these calls for $1.50, I'm sorry, sell these puts. $4.50. Where's the margin? There. Look at the 8. Wow. So I'm selling 10 of them. The margin on this is nothing. You're collecting $1,500, and your margin is $851. That's for doing 10. If it was for 1, you'd be collecting $150, and your margin would be $85. So that's a fantastic margin efficient way to play. So in other words, so you could do that flat and just do that and have a very, and collect, basically going to make 100% on margin doing that. But you can then pair that with the bull call spread, and that's a spread I think is going to be a real good payoff down the road. Questions, right? That's what I was doing. What is the TOS symbol feature for the DAX? I don't think there is one, frankly. As far as I know, there's not. Let's see. DAX. I mean, there's EWG, but it's not the futures. No, there's no... as far as I know, there's not. I mean, maybe somebody knows, but I don't. I mean, I'm sorry, that's in the U.S. I'm sure, obviously, if you're in Europe, I'm sure there's a symbol for it. I'm just saying, as far as my system goes, I don't have it. Oil is pulling back, yep. A lot of restaurants don't eat food. Yeah, I know. I actually work with a food bank in New York. It's a program I've been working on for many, many years. It's one of my pet. I could go on for hours about that. It's one of my pet peeves, is like the waste of food in the restaurant industry. And you say a lot, but the reality is, unfortunately it's not a lot. It's a shockingly low amount compared to what should be doing it. TOS stands for Think or Swim. Steve, we are directional in several of our positions. Why not hedge them? I like spreads. Yeah, we're going to have to look at that. We are. I assume you're talking about the options opportunity portfolio, maybe the short-term portfolio. But either way, yeah, we've taken some directional bets. And we generally like to hedge, but sometimes we take a bet because we're betting. We think something's going to move. Unfortunately, we just got hammered on our bid on Sotheby's because they had a bad auction. We're going to have to give that some time to fix itself. But it just depends. I mean, I don't like to hedge every position, otherwise it's very boring. I mean, in fact, we have a portfolio like that, the butterfly portfolio. Oh, which, by the way, next weekend in Washington, D.C., we're doing a webinar on Saturday, the 14th. We have not a webinar. We have a seminar live at the Carlisle Hotel in Washington. It is a fee, and it's on our website if anybody's interested. Actually, Greg at philstockworld.com. You can get him at Greg at philstockworld.com or admin at philstockworld.com. If you want to arrange to go last minute, I guess probably the best thing to do would be try to contact him. But that's next Saturday, 10 to 6, we're going to be in Washington, D.C. at the Carlisle doing a live thing. And it's going to be basically just focused on the butterfly portfolio and setting up those kind of well-hedged positions for the long term. JW says, I thought if the dollar rises, the indexes fall, and therefore the... No. That's the opposite, yeah. No, if the dollar rises, see, if the dollar rises, our indexes fall because they're priced in dollars, so you need less dollars to buy them. But the Nikkei is priced in yen, so if the dollar rises, the yen becomes less valuable, and that means you need more yen to buy each stock in the Nikkei. Not the opposite. You're just thinking it's all the same. It's not. You have to think in terms of the currency that index is priced in. We're very spoiled in the States because we think everything revolves around the dollar, because most things do. Like all the commodities are priced in dollars, so you think everything's a direct relationship. But no, because obviously people in Europe aren't buying stocks in dollars, they're buying stocks in euros. People in Japan are buying stocks in yen. So when they see a stock, it's priced in yen. They don't give a credit, the dollar has no effect. But it does have an effect because the yen rises and falls, and they need more or less yen to buy something. and therefore the market moves contrary to the dollar, because if the strong dollar makes a weak yen means you need more yen to buy the same stock you would have bought yesterday. So I hope that clears that up. How do I feel about you guys? That one is going to decay. If you want to do it short term, it's fine, but long term, it has a lot of decay. All these ultra ETFs will decay very quickly on it. So I wouldn't do it for a long term play. One of our guys was making some really good money playing you guys on all these dips on NG, and it seems to go down and come back almost every day. It's like it finds the floor, comes back, finds the floor, comes back. We actually stopped making the big long-term trades, and we did a lot more in and out trading since last week. We had this webinar last week, and I was saying I still have those longs, but on the whole, though, I've been concentrating more on quick in and outs with natural gas, because those are easy. You can make 3 cents, 2 cents, 5 cents over and over and over again while you're waiting for the other one to kick in. So, and you guys is like that. You guys is like playing the futures. It's just a real quick in and out. What happened? What would your new trade on gold look like? A new trade on gold. We have old trades on gold, I guess. Look, it's going to be a rough ride for gold, so I think I'd want to set up something where I'm selling something. That would be kind of important. Let's see. So the first thing you want to do when you're thinking about it is you want to find gold, metals, gold, get a long-term thing. And, well, here's the thing, though. You look at the long-term chart, it's kind of scary, right? So let's not look at the long-term chart. I just think, look, the thing is, it's not 2009 anymore. The cost of refining is around $1,000. So it's not likely to go much lower than $1,000 or not stay there for long, because it costs that much to refine the gold. So this weekly chart makes a lot more sense, right? So here you go, long-term. We think this is the floor. 1050 is actually the floor we expect to have at the bottom. Although there's a problem, because Barrick Gold has significantly reduced their cost of extraction. So because Barrick Gold has decreased their cost of extraction through cost cuts, they actually, as the world's largest gold producer, they actually could be selling gold cheaper. And GG Gold Corp has also done that. So both of them have actually pulled their break-even point under 1,000. If they want to be dicks about it the way Saudi Arabia is, they can kind of start forcing their competitors out of business by allowing gold to go even lower than it has. So it's certainly not a sure thing. Over the long haul, though, I just don't see how we can't move back to a higher norm just because of all the money printing that's been going on in the world. So as a new play on gold, I would want to have a long-term bull call spread. And again, you get, whenever you're doing an ETF, you've got this decay issue. So you're at 104. So figuring 2 years, if we break even, you'd be at 100. Still 104. How much can we sell? We can get $5 for the 110s. Well, obviously we can get more. We can get $5.25, $5.30 for the 110s. Now, let's say we want to pay $5. What can we get? We can get the 100s for less, for 10, 15 or so. So for less than $5, you can get a 110. You can get a 100, 110 spread for less than $5. Gold's at 104, so there's no premium to that, but it's not that much fun trade. What if we went to 90? Is 1750, and 105 is 750. So here's the same $10 really. I'd rather have the 90. I'd rather have the 90. I'd rather have the 90. Oh wow, I'd much rather have that. What am I talking about? That makes no sense. Oh, did I do something wrong? The 100s are 10. The 110s, that's a $10 spread, are 5. That's a $5 spread. The 90s are 17. Oh, it's not. It's a $10 spread. That's why. Here's a $15 spread that costs you $10. If you went with the 9105s, that's a $10 spread. So it's really the 9100s, and they are 101. Here's 1020. That's $7. No, I wouldn't do that. So really, 95s are $13.50, and the 105s are $7.50. So here's the thing: it's going to be $6 for the 90, for the 95, for the 95, the 95 105 bull call spread. It's $10 spread. It's going to be $6. You can save $1, which isn't nothing. It's 20%. You can save $1 by instead betting on the 100 110 spread. I think I'd be inclined to go with the 100 110, and I would roll down if I had to. I'd rather save $1. So let's say you pick up the 100 calls for 10.20, 10.15. You sell the 110s for 5.30, for 5.30. So that's like $4.85. And I wouldn't sell any puts because, frankly, look, you're going to make 100%. Okay, 100% on your money. This is 2017. I didn't even think about that. Oh, there is no 2018. That's why. So in 1 year, you're going to make 100% if gold just basically holds 105. Why would you need to do anything else? 100% in a year is good money. If you put 5% of your portfolio into that, you would make 5% of your entire portfolio off of one trade in 1 year. That's good. You don't have to do so great on the rest of your portfolio for that to make a big impact. So I would start off with that. So it's the 90, so I would go with the 100, 110, bull call spread for 4.85, whatever. It doesn't have to go up much. And then if it goes down, only if it goes down, I would sell. And I would look to sell maybe the $90 puts. That would be $900 gold. And if I can get the $100 price, so let's say gold does drop $10. In that case, I would then probably be able to sell the $90 puts for what the $100 puts are, which is over $5. That's 100% of what you're paying for the spread that you get back in your pocket. Then at that point, you could then decide whether you want to spend money to roll your 95 calls lower. And you see, even right now, from 13 to 21, that's a $10 roll. From 13 to 21, it's $8, right? But from 105 to 95, well, we already know this. From 105 to 95 is $6. So in theory, if you sold these for 5+, and then you put that 5+ into the roll, you would be rolling yourself into the 95. I'm sorry. Where were we? We were at the. Yeah, we were at the 105. You'd be rolling yourself into the one. You'd be rolling yourself from the 105. No. I need a playbook for this. The 100s. The 100. You could roll the 100s to the 90s for the price of the 90. For the 110s, roll to the 100s, which is $5. So for the same money you collect, you could roll to the 90 110 spread. Then you'd be in a $20 spread for the same net $5 you were in the $10 spread for. And then if it bounces back, it gets very exciting. That all depends on timing and a lot of other things. It's a little complicated. But the bottom line is, you can see ahead that you can maneuver this place and change it how you want. So then let's say you did 10 of those for $5,000, right? You could then sell, let's say, 5 January 110 calls it's for 78, whatever, 76. And that's going to be, I can't pull it up. There. Oh, I hate this calculator. Pull my old calculator back. So then we're looking at 78 times 5, $400. So in just 2 months, you're collecting 400. Don't forget, you're only laying out $5,000. So for just 2 months, you're collecting basically $400 against that spread, and you're very, very well protected, of course. So I would do that, because that way, if it goes lower, every time, if it goes lower, if you're going to sell these over and over and over again and collect $200 a month, you're going to pull $2,000 over the course of the year while you're waiting for your spread to mature, and that's going to lower your cost basis on the spread. So that's probably how I play it. And of course, you want to keep stops on the short calls, because gold could go flying up. So you don't want to get too badly burned on something like that. Let's see. Goes up stronger, the yen becomes right. Okay. What specific year and month of the UNG spread? Do we talk about it? Oh, my brain is not working today. What year and month for the UNG spread? What UNG spread were we talking about? I think I was talking about 2018, wasn't I? None of these are official trades. These are just things we're talking about as far as examples. So for UNG, we talked about the 7-12 bull call spread 2018, buying the 7s for $4, selling the 12s for $2. And you see, in fact, here you go, last sale, 403, 203. So while we were talking about it, somebody was doing it. That's a $2 spread. All right, so you buy those for $7, and then you sell the $8 puts, $4.50. Somebody sold it for $1.40. And that would net you, well, in this case, it would result to $1.40. That nets you 60 cents. So you're selling the $8 puts into all 2018. So you're buying the $7 calls, selling the $10 calls, selling the $8 puts. The net is 60 cents on the $5 spread. Your risk is owning UNG for $8, but that's quite a bit. It's like 20% below the current price. So it's not a terrible thing to have to do. Risk reversal, Thinkorswim, IBM. Why are we randomly talking about things? Okay. IBM. Yeah. IBM is going to be our stock of the year pick for 2016. They have not been performing well, but we have a lot of faith in them long term. I think they're on the right track with what they're doing, and people just don't see it. People are impatient. Hell, people are impatient about Apple. Look at Apple today. They're falling back to earth. Because there's been a no doubt that their suppliers, there's a no doubt that they've cut back on some of their supply orders, indicating you would think slow sales. I haven't seen this new iPad yet. I'm wondering if people are going to buy that. It's supposed to be huge. And I've been thinking about it. If I love my iPad, I would freak out if anything happened. If I didn't have an iPad, I don't even know how I'd live my life anymore. So I want a new iPad. I want a bigger iPad, but I'm not sure if it's too big or if it's too heavy. I got to find out. So we'll see how it looks this weekend. But absolutely something. I mean, I can't even imagine not having this pad with me all the time anymore. Anyway, so IBM is selling off lower than we thought. We think 140 is a fair price right now, and over the course of next year, I fully expect to get 160 to 180, and in 2 years, I expect to be up around 200. So we're going to be doing a 2018 trade where we're targeting a move back towards 200 over the next 2 years. Now that we're at 135, that's a pretty significant move. It's like a 50% move up. So look, let them sell off and let them settle. But I very, very much want to be long on IBM for the next 2 years. I think that Watson's a huge game changer. I think that they saw that years ago when they first rolled it out, and the moves they've made in the company have consistently been towards a Watson-driven revenue stream model, where they look, IBM has done a lot of stuff, and they focused heavily on the cloud, because where does Watson live? It lives in the cloud. And you need robust cloud architecture because they can't give you Watson. You can't have it. It lives on their servers, and it's a massive thing. It's like Google. Like, you can't have Google search engine. It's too big. Watson is like Google search engine. It's too big. You can't have it, but you can connect to it through the cloud. So that's everything IBM is doing, is pushing and building and creating this cloud architecture, not even to sell cloud services so much, but to support Watson. And supporting Watson means, we talked about this before. But I mean, look, anything that requires simple questions and answers, anything where you talk to somebody on the phone and you need a question or you need something done for you or whatever, anything that can be done by a computer can be done by Watson. And it's going to replace millions and millions of jobs. And let's say IBM replaces 1 million jobs and only charges $5,000 for each job it replaces. Okay? Do they even have to do a good job of replacing people? No. Indian call centers have proved that, right? They're not good, but they get the job done for companies. So there are millions and millions of people employed in India who are incredibly annoying to talk to. No offense to Indian people, but not all of them are great. I talked to plenty of Indian call centers where they're really on top of things, so there's tons of low quality ones. Watson doesn't have to be perfect to replace millions of people because cost-wise, it's just a computer program. And on the whole, it's just a computer program in the end. But it's a computer program they can charge $5,000 a year for a license for. So each individual incident of an employee they replace at $5,000, 1 million employees is $5 billion for IBM. 2 is 10. 4 is $20 billion per year. Almost pure profit. Just running a computer program. Okay, 4 million jobs replaced by Watson is $20 billion a year, and that's even assuming they only charge $5,000 to do it. Plus, though, once IBM has their hooks in you for Watson, then they start selling you all kinds of cloud services. They're like, hey, you're on the cloud anyway. You're using us anyway. We can do your backup. We can do this. We can come in and help you with all your other computer services. It's fantastic. Okay, it's going to be a huge thing for them all around. But it's a long-term thing. It's a changing, changes don't come overnight. Like, remember Apple, when the iPhone first came out, people talked about the ecosystem of the iPhone, that people would buy an iPhone and that would make them buy more iBooks, and that would make them buy more iPads, and that would make them buy more iMacs. That's what happened. But it took years. And even after people talked about the logic of the Apple ecosystem and how well it was going to work, Apple still went down to like $85 for a while. And at the time, I was sitting there doing the same thing we're doing with IBM right now. It was going down, even though it was very clear what was going to happen in the future with Apple. And it went down, and I was like, buy it, just buy it, buy it all the time. If it got lower, I said buy it again. It didn't get lower than 85. But it went to like below 100. I started telling people to buy it. It went to 85. I was like, are you crazy? People would say, oh, I bought it at 100, it went to 85. Should I sell? I'm like, no, buy more. It's like, let it go to 60, buy more. There's a certain value to something. When you can see something coming in, nobody else is close to what IBM is doing with Watson. There are no other AI programs doing what Watson does right now. All right, you got Siri, and you've got Microsoft Corota, whatever the heck it's called. And you've got Google doing their thing. Google search is very good, but it's specifically a search algorithm. That is not the same thing at all as what Watson does. Okay, Watson is a much more conversationally oriented, much more human interaction oriented. Anybody who talks to their phone knows this, that they're pretty useless for a conversation. Watson can engage you in a conversation. That's a big difference. I mean, the commercials are exaggerated, but generally it can. And that means it can answer questions, it can learn, and it can help you. So when you want to book an airline ticket, if you call Watson and say, I want to go from Newark to Sydney, maybe the Thursday before Thanksgiving, it knows exactly what you're talking about. It doesn't have to say, what do you mean by Newark? It doesn't have to say, what do you mean by Sydney? It understands the context of what you're saying, and it understands that you mean from Newark Airport to Sydney, Australia, which isn't the name of the Sydney Airport. You know, so in other words, it understands conceptually what you're talking about. You don't have to be super specific, and it figures it out with a high degree of accuracy. It'll say back to you, do you mean you want to go from Newark Airport to Sydney to such and such airport in Australia on November 14th, which is the week before Thanksgiving? You say, oh yeah, that's what I meant. You know, and that's a transaction. And that makes it smarter than a lot of call centers you're going to talk to. And therefore more valuable to the company. And when it's more valuable to the company and costs them less than half as much as they're paying now, they're going to switch. And that's just, you know, one little example. There's so many different ways that this thing is going to get used. You know, I mean, almost to a scary extent, almost to the extent where you're going to have to worry about, like, large-scale unemployment down the road. But that's not IBM's problem. IBM's going to be raking in the cash. But it's a long-term thing. It's going to take years. Just like Apple took years to really move along. Here's Apple, in fact. Look at the 10-year chart for Apple. Look at Apple. This is, look, here's 06. Here's 2009. I mean, this is, you know, they've obviously had their splits and all that since. But you're talking about $8. When did the iPhone come out? iPhone release. Oh, let's look in the old ones. See how small Google is? I misspelled release and it figured me out. iPhone history. God, it's hard to remember the life of that my iPhone. It hasn't even been that long, has it? Early 2007. Okay. So, wait a second. Here you go. So early 2007, somewhere around here, Apple announced the iPhone. Now, it's weird because they did a split where everything was different prices, but they were at 17. They went up to 19, 20, oh, here you go, 28. Okay, so they went up to 28, which is a big move, went back down, all the way back down to 17 again, back up but not as high to 27, all the way down to 12. 2 years after announcing the iPhone, it was already in people's hands. The excitement wore off. People got sick of it. They didn't see how it was going to. They said, it's not such a big deal. Who cares? Blah, blah. And it wasn't a fluke. It wasn't a one-time thing. It was from, you know, I mean, there was a crash of '08, of course, happened at this time. But all the way from October until March, you could buy this thing for under $15. And this is back at the time when I was pounding the table and telling people, buy it, buy it, buy it, buy it, buy it, buy it. And it just went up and 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 up, okay, to a ridiculous extent. Then it pulled back a little, and then it started going up again. All right, this is the first time it hit $700, in fact, over here, where it says 100, that's the $700 line. From 85. So that's what happened to Apple. But here's the part you want to be concerned about. What happened? He announced it here, and the stock really had a little bump, and then people got bored. What happened to IBM? Same thing. IBM I think it was 4 years ago now. I'm not sure. I'm going to check that. Watson. Jeopardy. So technically, this is when they kind of announced Watson. $2011. That was a long time ago. That was 4 years. No, that seems like a long time ago, right? It was only 4 years. So here we are. So here's 2011. All this time, people, it was all announced and people were talking about it and it all came in. So the peak excitement for IBM came. They went around $200. But here we are 4 years later and nothing so much has really happened. And now we're back to 135. Meanwhile, IBM, though, has been making all the moves and changing their business and doing all the stuff they need to have a Watson future. People are just bored waiting. Just like they were bored waiting for the iPhone to do something. These things take time. And traders don't tend to allow time for things. They don't have the patience for it. This is what you take advantage of. And we've been waiting and waiting and waiting. I've been waiting for IBM to come back down. When it was up here, I wasn't buying it. When it's down here, do I want it? This is a very, very fair price for IBM right now. And especially, look, 135 a share, 19 billion in sales, 3 billion in profit, okay? And that works out to what? $15 a share. $15 per $135 share is a PE of about 9. That is ridiculous. This is not this is not a commodity company. It's IBM. They make you $15 a share. And not only that, they pay you a dividend. They pay you $5. That's not nothing. They pay you a $5 dividend on top while you're waiting. And not only that, but they're buying back stock at a rate of 5% a year. So they're even decreasing the amount of outstanding shares while you're waiting. It's too many reasons. Too many reasons to buy IBM. That's why it's my stock of the year for next year. And by the way, what constitutes a stock of the year pick for us? It's the stock we think is most likely to give us a 500% return on an option spread. So that's what we're going to do. We're going to set up in 2 years. We're going to set up a 2018 option spread that has a 500% return on cash over the next 2 years. And IBM is it. And then thank them for going down even lower because I love it. All right. Let's see what else. Can you suggest a bull call spread for T? We did that, didn't we? I thought that was one we talked about last week. That's easy. Now, AT&T doesn't really go anywhere. Keep that in mind, okay? It's a very boring stock to own. So basically, you don't want to bet on it to go anywhere. You want to bet on it to be where it is. So you take I would go with the 25 calls, which are $7.90. I would sell the I'd sell maybe the 30s. Yeah, no. All right, you know what I would? I'd sell the 32s. So, oh no, that's a terrible spread. Sorry. That's too expensive. All right, let's see if we can figure something else here. I don't like these prices. These are not friendly prices. Let's see if we can figure something else out. I don't know why they had better prices before. These are like obnoxious prices. The problem is that the calls are too much. 28, 25, 32. No, don't like it. 5 here. Obviously, these are better than those. I don't like it. You got the dividend to take into account, but on it, no, you're not buying the stock. The problem is that the way AT&T is right now, these calls have too little premium. So the calls you want to sell, the short calls, have too little premium. And honestly, these have too much. I mean, you're not getting enough money back. I guess if I was going to do it, because you got the dividend too to consider. You know, we talked about buying the stock. So if you bought the stock for $32, I wouldn't do a spread. That's what it was. Because when we looked at one we liked, it wasn't the spread. If you buy the stock for $32.75, I don't know where my calculator went now. I don't understand why that doesn't work. So $32.75, you sell the $32 calls for $2.60, $2.50, let's say. That's what, $30.25. Then you sell the 28 puts for $2.50, so that's $27.75. All right, so that would give you your net. So in other words, if you sell the 28 puts for $2.50 or better, you can sell them for $2.65 or something like that. But whatever, let's say you're in for about $27.50, let's say. So you're selling these 28 puts, you're buying the stock, and you're selling the 32 calls. That nets you in for $27.50, and if you end up getting assigned more on the 28, you'll still be in for $27.50, a little bit less. Now against that, the key to that is that you're going to collect the dividend. So yeah, I wouldn't play it for the bull call spread. I would just play it for the as a dividend play, and you're going to collect $1.88 against $27.50. So that's 188 divided by 27.50. That's 6.8%. So you're going to collect that twice. So that's what, 13%. And then if you get called away, you're going to get called away at 32 minus 27.5 plus what? Yes, right. Plus 1.88 plus 1.88. 2 years worth of dividends is 826 divided by 27.5. 30%. So you make 15% a year. That's the way I like to play it. You're not playing it for a big gain. You're playing it just for a nice, safe dividend play. So in other words, you're buying the stock. You're selling the 2018 32 calls. You're selling the 28 puts. So your risk is owning 2 times whatever you're buying now for about $27.50. And you're collecting your dividends. And your net at the end, if AT&T is over 32 and you let yourself get called away, your net return is going to be 30% back on your money over 2 years, which is fine. The reason it's fine, though, the reason I like AT&T is because you can put $1 million into a play like that. You know, you can put huge amounts of money because you're not really worried about it. It's not like a volatile stock that's going to fly up and down. It's not going to kill you. If you have a huge portfolio, these are the kind of stocks you want to be in. You know, the more safer blue chips. Now, technically, IBM is one of those safer blue chips, but apparently not this month or this year. All right, let's see. Oh, what is it with the sound? I don't get you people. I hope it comes back. Okay. Restart if sound lost. Okay. Now, where are we? Phil, is FXI the ETF for China or Hong Kong? It seems to mimic Hong Kong. What about Chao? What? So the China Ultra is the CHAD and CHAU? Where the hell? FXI is I believe it tracks the Hang Seng. Let's take a look. I'm pretty sure it does. I don't think you can. I like FXI because it's liquid. It's not just about whether it tracks it well. if China goes down, the Hong Kong goes down too. It's not like it's divorcing it, those, especially the way they got the exchange is more tied up these days. So I like playing FXI because it's more liquid and, frankly, because it's unfairly getting punished for problems in China. But more and more they are linking those exchanges, and more of the companies are bleeding across, so they are getting more interwoven than they used to be. So it is, and just, again, whenever you're given a choice, you want to be in the ETF that has a good amount of liquidity, and those others do not. Stephen Holt says 2018. I bid 2019. Sandra says 18x. I bid 19x. I have no idea what these conversations are that you people are having. What's your trade on IBM? We just talked about that, and officially I haven't got one yet. We haven't done the official trade of the year yet. Steve says, Apple, you're comparing 2008 bottom to a record high. IBM would be great if we were lows like 2008. Yeah, it would, but we're not, and we're not going to be. So, you can say that about any stock. You're going to never buy a stock again because we're not at the 2008 lows. IBM is not a fist-pounding buy, sell your house and buy it like Apple was, because that was a unique circumstance. But I think it's going to be a great stock for the next 2 years. So that's why it's my choice. I mean, you'll never get, hopefully you'll never get a chance to buy things the way we bought them in 2008, but if you do, that's one of the reasons we like to have cash on hand at all times, just in case. Stanley says, FYI, UNG, there's an RR in the loop. There's an RR in the loop. Oh, yeah, there's a trade. We have a trade on UNG in the option opportunity portfolio. That's correct. We have an aggressive one, and we are going to have to probably move it. It's not January, though. I don't think so. I'm pretty sure we moved it. Let's see. Options opportunity portfolio. 5% portfolio. Silly me. 12.6%. We're getting killed by bid. That's why. This one is totally at minus 6,000 right now. Very bad. Let's see that. All right, so that one's there. Oh, it is January. I'm sorry. No, it's January puts. I knew we didn't have January. We have April. So we have moved to, in UNG, we have the April 11 short puts. We have the January 12 short puts, and we're not in good shape on those either. And we have the long April 8 calls. That's our position there. Let's see. Still watching NRF, 2 cents. Yeah, no, NRF is a big mess because we have that one in our long-term portfolio, but we haven't figured out how it's all split up yet. Well, we did actually. We just went through it yesterday in chat. But it's all broken up and all the pieces are different now, and we're still just waiting for the dust to settle on their breakup. Nothing bad, but just, they broke up the company into different pieces, and we now have to figure out what we actually own and see if we want to own it. That's the other thing. Still in LL. Yeah, we still love LL. I don't know what they've been doing the last few days, but lumber liquidators. Well, that's a big long for us in our long-term portfolio. Well, but apparently not on this chart. LL. What the heck? I have no idea why that's not working. All right. Let's take a look at 1 year, 2 year. Oh, not so great, 15-something. But, you just got to let this whole crisis that they're going through, and you just got to let it wash away, and things will get back to normal. And all we want is for them to get to 25 by 2017. That's all we're asking for. Not a very ambitious target, I don't think. So yeah, we're hanging on. What's the news today? Why are they down 5%? Whitney Tilson, what to make of lumber liquidators holdings? Good news, bad news, or earnings? Oh, I see. So basically, people are interpreting their earnings negatively a little bit. Analysts aren't turning bullish yet. Yeah, well, whatever. I just think I think there's so much bearish in it that I can't see how you could say anything that, having not gone bankrupt is a big plus for them right now. That was your earlier trade proposal. Okay, restart of Sam loss, Phil. T won't go down in value next year if interest rates rise. Not much. They don't. I mean, they may or may not go down, but that's not what you're buying for. You're buying for a long-term dividend player that's going to be around $30. Okay, they may go up, they may go down, but who cares? Because all that's going to happen is they're going to get to 2018. You're paying. Don't forget, you're paying net $28.50 for the stock, or net $27.50 for the stock. You're collecting your dividends. You sold your puts and calls. Doesn't change your net. If they're down at $27.50 in 2018, then it doesn't matter because you don't owe any particular money. The 32 calls that you sold will expire worthless, and the 28 puts you sold will also basically expire worthless. And all you're going to do then is sell 2020 puts and calls for another $5, and your basis is going to be $22. You understand? You don't have to realize the gains in the end. You only have to just keep reducing your basis, and after a while, you still, it may take a couple of years longer, but you still get all your money back eventually that you put into the stock, and that means you have a zero basis stock down the road. And, in 20 years, but in 10, 20 years, you have a zero basis stock that you just keep collecting dividends on. That should be the goal of every investor. You should have a whole portfolio of that. So you've gotten all your cash back, you put your cash to work hopefully in other things and made some other money, and you're collecting dividends on what's left. And then when you die and you leave your stock to whoever, they can decide to cash it out or something. But meanwhile, you're just going to live off the dividends forever on these things. That's the long-range plan, and that's something we should talk about when we're in D.C. Long-range planning. May says, Phil, what can we do with the bid position in the option opportunity? We can do nothing with it right now. It's being sold off. People are not happy with the way the auction went. I didn't think it went that badly. That's other people's opinion, though. And the only thing you can do when you have a position like this is be patient. That's why we went to April, so we wouldn't have to panic out of it. We're not forced to do anything. Somebody sold the crap out of the stock. Okay, for the last couple of days, it's been sold and sold and sold. The news is not that bad. It says analysts have lowered their targets. Who's lowered their targets? Sotheby's shares after dropping, fourth quarter. Okay. Oh, the Craig Hallam Capital Group. Oh, they lowered their price target to 34. They call the accounting treatment of the guarantee surprising. Okay, let's take a look at that. Analysts warn of lower profits and won't report revenue from the sale of 500 works until they exceed 515 guaranteed sellers. The company needs to generate $95 million in commissions to cover the guarantees, and that may not happen until the first quarter. That's interesting. So, see, that's really interesting. All right, I understand that. They picked up the guy who used to be the CEO of Sotheby's. They took over his whole estate. They guaranteed that they would sell $500 million. Now, that includes their commission. Their commission is maybe out of that $100 million on all that. So they guaranteed essentially, let's say 420. So they guaranteed they would sell the stuff for $420 million and that they would get an $80 million commission on top of that 20%. And that would be $500 million total. So far, they have not sold more than about $400 million worth of it. They still have to sell, well, actually, that's 95. So they sold $4 or $5 million so far. They have plenty of stuff left to sell, but they didn't sell it at the first auction of the year, of the season. I'm sorry, not the year. The year goes into next season. So the company's still sitting on a whole bunch of stuff it needs to sell. Now, accounting-wise, what they could do is they could book what they sold so far, but if they book that, they have to take technically a loss. So in other words, they're going to not book the sales of $405 million, because if they book those sales, they would have to basically say, well, we're taking a loss of $95 million because we guaranteed $500. But in reality, the sale's not done yet. So what they're going to do now is take the whole auction and not book it accounting-wise until they get their $515 million goal, and then they're going to book it with the profit. So meanwhile, what's that going to do, though? What that's going to do is it's going to make the fourth quarter very light, because they're not going to show any profit. Even though they've made the sales, they're not going to show any revenues generated from this auction at all. Okay, I hope that's clear to everybody. So, well, it's an accounting thing. But this is idiocy, of course, because who cares? Is their business working or not? Are they making sales? Are they making money? Just because they move it around in the books, it doesn't make it a bad company. So this guy lowering his price for the stock from 50 to 38 just because they moved the sale, unless he means for the end of this year. I'm not sure what they mean by that. So Steeples lowers it from 50 to 38. These guys lower it from 40 to 34. Meanwhile, both of these targets are higher than the stock is now by a wide margin. Okay, let's keep that in mind. This is very interesting, actually. It was an interesting situation. All right, so that explains what's going on in Sotheby's. It's just they're moving things around, they're moving the time frames of the auctions around. Obviously, it would have been nice if they had put everything in and it's all sold, for higher prices. But they're going to barely make their money. They're going to barely make what they promised they'd make. It's not that they blew it. It's not that they blew it. It's just that there wasn't as much excitement. And part of the reason, though, it's not even. It's funny because there's a lot of articles being written right now about New York's $2 billion fall art auction season. $2 billion is a really lot of money, and the dollar is very strong internationally. You have to realize that also. So right now, compared to last year, the dollars that they're getting for the auction are killing the Chinese people and the Japanese people and the European people who usually buy at these auctions. When they hear this price, the price is 10 to 20% higher than it was last year because the currencies have changed. And nobody takes any of this stuff into account. It's really stupid. I mean, it's a very weird thing. Okay, nobody takes currency into account in almost anything that's done. So anyway, I still like Sotheby's. If they're not improving by the end of the year, we're going to move the Aprils to a longer position and just make it a longer-term trade. But there's nothing wrong with Sotheby's. This is all very silly. From an earnings perspective, they probably haven't changed it yet. So you're talking about a $30 stock. They're going to hit their numbers this year. They're going to make $2.10 a share this year for a $30 stock. That's a 15 PE. Next year they're going to make $2.59. That brings them down to an 11 or 12 PE next year. All right, so this is just stupid. To have the thing sell off like this is just silly. We're going to take advantage of it, but we don't know where the bottom is, so we're going to wait patiently and see where we find a good base to go off of. But absolutely, this is in no way does this make me not want them. Bid and oop. We're going to talk about that. Are you feeling very bearish? I'm not very bearish. I just think things are too expensive. It's like it's like if you're buying houses, right? If I'm going to go buy a house and I live in a 4-bedroom house and it's $350,000 or $400,000, and I go to buy and I go out to buy another house, but every house I look at is $500,000, $600,000. It's not really better than the one I have. Okay, that doesn't make me bearish on houses. It just means I don't want to buy a house right now. I think they're too expensive. But it doesn't mean I think it's going to imminently crash. And that's the same thing with the market. There's a difference between being bearish, where I think the market's going to go down, versus just thinking things are too expensive to buy. And that's where we are right now. Mostly things are too expensive to buy. They could go down, but the only catalyst that's going to drive them down really is probably going to be something unbalancing in the world, like in China or somebody like that, some country finally falling apart and swap spreads moving forward or something like that. That's not that likely to happen right now in the environment we're in, which is everybody just prints money whenever they feel like it to cover up any problems. So I'm not bearish. If I was bearish, we'd have more puts in our portfolio. We don't have any puts in the portfolio. We're not really making any bets. The main bearish bets we have are hedges against our long positions. We have lots and lots of long positions. I mean, in the long-term portfolio, where's the long-term portfolio? In the long-term portfolio, there are zero. Well, no, I'm sorry, there is one, I think. We're short on Netflix. Here's Netflix calls that we're short on. So other than the Netflix calls, there are no short positions in the long-term portfolio. We've got 22 short puts, all bullish. We've got a bull call spread on rig bullish. We've got covered positions here that are bullish, and 21. So we have like 50-something positions, all bullish, in the long-term portfolio. It's hard to say what the value of it is. It's quite a lot of money. I mean, you know, we have at least. I mean, well, here you go. In fact, here's the credit on it. It's market value minus 154. So we've got 869 in cash against a portfolio. So it'd be about $150,000 of short puts that we sold. So in other words, if next year these things move forward and the market's generally up, we're going to pull $150,000, $200,000 of additional profit on this portfolio. Now, $200,000, this is a $500,000 portfolio when it started. That's a 40% profit in a year if all goes well next year. That's how bullish we are. So yeah, don't confuse my careful tone about the market with being bearish. Bearish would mean I'd be betting everything short. We wouldn't have any of these positions. We have tons of long positions, tons. We are cautiously protecting them in the short-term portfolio. And we've always done this. So we've done this from day one. The short-term portfolio is up 200%. And why is it up 200%? Because every time the market fell, we cashed in our short positions, and then we left ourselves very bullish until the market ran back up to about where it is now, frankly. And every time the market gets back to where it is now, 2100, we buy a whole bunch of short hedges in the short-term portfolio. But our intention in the short-term portfolio is after we have a nice dip, we cash in the hedges. And then we risk taking a loss. See, we're not going to take a loss now because every time the long-term portfolio goes down, the short-term portfolio goes up right now. And we're up to like $336,000 in this thing. That's a $100,000 portfolio when it started. So every time, and when did it start? Thanksgiving 2 years ago. All right, so every time we get to 2100 on the S&P, we load up on these hedges that we have in this portfolio. It's not always all hedges, but frankly, this is fairly bearish because we don't really have any longs in the short-term portfolio. There's really very, very little in here that's a long position. We have, in fact, our long is we're long on gold, we're long on silver, we're long on the liquidators. That's it. So these are a lot of bearish positions in the short-term portfolio. But the point being, when we do have a sell-off, we cash it out. And then the cash that we have in the short-term portfolio becomes the hedge for our long-term portfolio. And what do? If this hasn't happened, by the way, but if the long-term portfolio, if the stocks broke even lower than we thought, below 1850 on the S&P, if we had a break even below where we thought we'd hold up, then we would take the cash from the short-term portfolio and use it to buy more long-term positions, which is exactly what I was saying before. If IBM goes to 100, we'll buy more of it. And how are we going to buy more of it? We're going to pay for it with this money that's sitting around doing nothing. $300,000 of cash in the short-term portfolio doing absolutely nothing because we've never had a need for it. It's just sitting there. I'd love to put it to work on long-term positions, but the long-term positions haven't gotten particularly cheap enough to move the money there. So that's how that works. The 5% portfolio, we have the hedges built into the portfolio. The butterfly portfolio also is self-hedging. The long-term and short-term portfolios are a combination. And look at this butterfly portfolio. It's so great. It was like at 88% a month ago, and now it's at 84%. It just hangs out. You know, whatever the market's doing, it just hangs out and stays around where it is. But it grinds out like a little money every day. These are wonderful self-hedged positions. This is, by the way, the portfolio we're doing the seminar on next week. So we're doing a live seminar in Washington, D.C. next Saturday on this portfolio, how to make it, how to set it up, how to build positions, how to manage the positions, everything about it. That is the main purpose of that seminar next week. All right, in this seminar, we got to wrap up. So quickly, let me answer questions. What do I think of the index levels here? Too high. Look, and again, in a vacuum, if it was just America and we were all by ourselves in the world, I would think they're about right. But it's not. The danger of the global economy is such that I feel that we should probably be overall pricing more risk into the market. It's not priced in. We're pricing in perfection. We priced in perfection in 2008. It was a gigantic mistake. We're pricing in perfection now. I don't think, in no way, shape, or form are things going to be as bad as 2008, but I do think that China could collapse, Japan could collapse, we can see some serious repercussions, and we could fall 10 to 20% from that. Is the U.S. going to collapse? No, there's nothing wrong with the U.S. And frankly, if China does fall apart, or Japan falls apart, or something goes wrong in Europe, and our market gets dragged down 20% with them, I'm going to be banging the table to buy stuff. That's what I'm waiting for. That's what I want. But I don't want to buy at these prices. All right. May, seems like traders are getting pretty bearish. On TLT, should rates go up? What is your outlook for SPX in December 15th? Geez, my outlook for SPX December 15th. I think that we shouldn't be at 2100. I think that by the end of the year, we should be back around 1950, 2000. I think we should be a bit lower than we are now. Where are we now? I don't even know. 2077, so 100 points down. I think we should go down a bit between now and December. And especially if the Fed raises, we're bound to have some sort of temper tantrum. Bid, I thought they guaranteed $5 million. No, they guaranteed $500 million. So you're off by 2 decimal places. But it's perfectly. It's the way the auction business is now. Okay, the guy had 500. I think it was 500 pieces of art. And they didn't arbitrarily say, they don't arbitrarily say it. They appraise every piece. They look at every single thing. And they say, okay, here's what we'll do. And Christie's, meanwhile, is doing the same thing. And they're both bidding to get the collection so they can make their commission. Because there's let's say there's $100 million commission in the whole thing. So how do you get your hooks into that $100 million commission? You've got to promise something the other guy's not promising. You can cut your commission, but more creatively, Sotheby's said, you know what, we're going to guarantee you're going to get at least $500 million. Or we're going to guarantee you 400 plus whatever, whatever the net is of his. So let's say they're saying we're guaranteeing you $420 million or $430 million. That's our guarantee to you. And that means that they anticipate selling it for $500 million. That's a net guarantee for them. So that's how it works out. And Christie's, I'm sure, put in a bid that was similar, but they lost. Okay, Sotheby's won. Did Sotheby's overpay? I don't know. It's a huge collection. It's very unusual that such a huge, they guarantee paintings all the time. These auction houses always guarantee. You get a Picasso, you think, they don't randomly get it. They're both bidding on the right to sell the Picasso. And they praise it and they say what they think they can get. And they're usually not wrong. But doing a bid on a gigantic collection like this, that's painful. There's so much room for error. And because it has to be sold over 4, 5, 6 different auctions, it's very easy for, it's like the World Series. Like one game can go one way and one game can go the other way. But in the end, it probably works out to where the better team wins. Very sadly for the Mets this year. All right, must finish. On bid, I thought we were going to sell the 28 puts for 2018. We did sell some puts on bid. I'm not sure which ones, but we definitely did sell them already. That's $100 million, right? May says, but we'll wait for your instructions, right? Yes, none of these are official trades. We're just talking about stuff now. If we have official trades, we'll put them out. But we're probably not going to this week, in fact. We're going to wait and see what happens. Next week, though, there should be a lot of activity. So should we be looking for value stocks, not growth stocks, or both? Yeah, definitely we want to be in the value bin, and we want to be bargain shopping. And we want to, look, the things we want to buy are things like IBM that go down for dopey reasons. That's the kind of stuff we do want to buy. You want to stay away. Look, again, the reason I write these posts in the morning is because I want people to understand where my head is at. we're in a very, very top 10% economy. So in other words, anything that caters to luxury that rich people can afford, that's the kind of stuff where basically you're going to be safe. You know, luxury hotels, luxury travel, luxury, BMWs, things like that. They're not having a problem. But if you have stuff that needs to be sold to billions of people don't have money. They're hurting. So we want to stay away from stocks that require a large amount of people to be buying them. And that means that P&G and things like that, they're not necessarily going to be doing great. McDonald's not necessarily going to be doing great. Disney not necessarily doing great. You know, so if they're low in a channel, yeah, they're still good stocks. But, you know, even IBM, companies aren't spending a lot of money on R&D right now, but they are saving money. And that's why IBM's changing their direction, and people don't understand that. Companies want to save money. They don't want to spend money. So IBM's saying, well, we have a way to save people billions of dollars. And that's what they're going to do. They're going to go in there and they're going to tell McDonald's that, hey, you've got 40,000 restaurants and you can eliminate 2 shifts a day. You can eliminate the person who takes orders. 2 shifts a day, every single restaurant you have. So that's, let's say they pay those people $15,000 each. So it's a $30,000 job for 2 people. And IBM is going to tell McDonald's that for $5,000 we can replace those in 40,000 restaurants. Well, it wouldn't be 5,000, it'd be 10,000, whatever. But let's say 10,000. So IBM says here's 40,000 restaurants times $10,000, $400 million. One sale to McDonald's is $400 million. Now, you multiply that by the rest of the fast food industry, and you've already made a $4 billion sale. So IBM's about 10% of the fast food industry. All they're doing is replacing the order taker with a machine. 24 hours a day, 7 days a week, never gets sick, takes all the orders, but doesn't just take the orders, because think about what's happening. You're giving your order directly to a computer. The computer is then it's automatically printing everything and tabulating everything, and when you start running low on something because you're giving your order to the computer then orders it from a warehouse and says, oh, the second you ask for more ketchup, the computer knows you just used your last ketchup thing over here, and it makes an order to the warehouse, and it completes the trucking forms and all the requisitions. The savings are incredible. It's like having the most efficient employee in the world working for you. That is tied into everything else that you do. That's the dream. Who's not going to want that? And don't forget, for IBM, this is where you have that ecosystem sort of concept, because for IBM, they're going to pitch this to you. They're going to say, hey, here's all the stuff we can do, but you know what you need to do then? You need IBM to come in and consult on your entire back office operations. You need them to help work on your whole system. But they're going to save you billions of dollars by doing it. They're going to come in there with a play that's going to save your company billions every single year, and all you have to do is contract with them. Not even pay them billions up front. You have to just contract with them to pay them about a third of what they're going to save you. Who's not going to do that? It's going to be gigantic. It's just hard to see because we're so early in that cycle. Would you look at MDR? No, we'll not look at MDR now. We're at the end of the thing. We can look at them. I mean, ask me in chat after this, because I'd be happy to take a look later. Can we have a webinar where you teach saving trades with examples from actual trades? Well, sure. Don't we do that all the time? But okay, remind me next week and we can talk about it. If you have questions, you really got to ask them earlier than the last 5 minutes of the webinar. Are we still on NLY, Annalise NLY as a REIT? The REITs are tricky. They're going to get sold off in bulk because people are just freaked out of them. But yeah, I'm going to buy more. If they go, well, NLY we're not in right now. We're in CIM. I'm pretty sure we're not in NLY. But yeah, I like them, and if they got cheaper, I would certainly buy them. And that goes for all the REITs we are in, though. I like them too. I love the dividends and returns. All right, thanks, and you're welcome to everybody. Thanks, Declan. And doesn't IBM have to cater to non-rich people? No, they don't. IBM is catering to corporations that have billions of dollars. Those are the top 1%. Their customers are incredibly wealthy, and they can make them more wealthy. So that's the ideal play. That's a sweet spot play that you want to be in. Okay, they cater to the top 1%, to people with money. IBM's not coming to you and replacing your secretary, right? Although they will down the road, but They're not looking for that kind of sale. What they're looking for is to replace thousands of workers in it at a time for major corporations that have billions of dollars of cash flow. And what they're doing is rather, this is the key to the sale. They're not asking for money. They're saying, we can save you money. They're saying to these guys, we don't need your money. We just need you to spend less money, and we'll take some of the money we save you. That's a huge thing. Would you be long on McDonald's long term because of their automation? Yes, I think that also it's going to help all these fast food places make more money, but it's not now. So, why was McDonald's halted? Does anyone know they were halted before? MCD. McDonald's won't spin off their real estate holdings. Oh, wow. Oh, I'm surprised. They were going to spin off their real estate holdings as a REIT, and apparently, I'll find out why later, but apparently it's something where tax-wise and whatever else, it wasn't going to be a good idea. I'm actually happy about that. I think that I like that. We missed it, though. We blew it. I don't know why we didn't buy McDonald's when they were cheap. MCD. Let's see if this works now. No, look at that. There's something wrong with this thing. I wonder what happened. Anyway, so that's weird. Ever since I've seen this, certain things don't work since I upgraded to Windows 10. So let's see. Anyway, well, we all right. Look, we know we blew it. Okay, we should have gotten in when they were cheap, and we didn't. We failed to purchase. Usually, I'm right on top of those things, and I don't know what I was doing. I did not catch McDonald's when they were super cheap. You know, down $90. Could have had it for $90. That was a great buy back then. We blew that. Anyway, I mean, certain things are just no-brainers, and that was a no-brainer. All right, last couple of questions. Do you think silver is nice? Yeah, absolutely. We love silver down here. This is a big trade for us. I swear we just talked about that at the beginning of the seminar. Silver, basically any 25 crossover here at 1425, we like them long. So in other words, here, I like them long at 1425. I like them long over 1450. I would not play them in between. It's too dangerous. If they go down to 14, I like them then. So you're basically talking about here with a tight stop below, here with a tight stop below, and 14 with a tight stop below. And you just want to hope you're going to catch a nice ride up. These are very expensive. They're $50 per penny. $50 per penny. So this little 5-cent thing here is $250. These are very expensive contracts. You have to be very careful trading silver. But in general, yeah, I love silver down here. It's way too cheap. Same as gold. Gold is cheap and silver is cheap. And that's that. And natural gas is 232 again. They're so funny. Natural gas is hysterical to trade if you don't mind getting in and out constantly. It's really interesting. I mean, it's like every day it does this. Look at it, up and down, up and down. You know, if you go long, you just got to feel it when it's coming down. It comes down to a line like 225 or 230. Lately, it's kind of getting around 230 and coming back up. And I think eventually it's going to come up to the next level at 240s will be next. But I'm pretty sure this is a really firm bottom at 225. So if we're lucky enough to get more at 225, I like it. But it's just been getting whacked every day. It makes some progress at some point, gets whacked back down, makes progress, whacked back down. It's so great when you pick the bottom. Obviously, so if you're looking at it, this isn't the bottom. When it comes down to 230, that's when you want to get back in. If it goes back up, then you missed it. Too bad. But if it comes back to the 230 line, that's when you want to take a little poke and see if you can catch it going back up. Also, though, another very expensive contract, $100 per penny on natural gas. So not for amateurs. All right, now I really have to stop. We're past our limit. Thank you guys all for coming, and we'll do it again next week. Oh, and I'll see, hopefully some of you guys, I'll see you live in D.C. on Saturday. All right, so have a good day, everybody.